If you don't understand bonds, you don't understand money. Most people think the stock market rules the financial world, but in truth, the $100 trillion bond market quietly impacts your mortgage, job opportunities, and even crypto prices. At its core, a bond is just a loan. Imagine starting a business. You borrow money and promise to pay it back with interest. That interest is the cost of borrowing, and it reflects the opportunity someone gives up by lending you their money instead of investing it elsewhere. Governments borrow too, especially the U.S. Through Treasury auctions, they sell bonds to everyone, from banks and pension funds to regular citizens. Why? To cover budget deficits, because America often spends more than it earns through taxes. In 2024, that deficit hit $1.8 trillion. These bonds come with key terms: principal, coupon, interest payment, maturity, and yield. Yield varies depending on bond prices. If prices fall, yields rise, and vice versa. Think of buying a $1,000 bond paying $30, then rates go up and newer bonds pay $50. Your old bond becomes less attractive, lowering its market price but keeping the same $30 coupon. This matters because rising yields mean higher borrowing costs for individuals, businesses, and governments. The U.S., with over $36 trillion in debt, rolls it over often using short-term bonds. If market rates spike, so does interest expense, straining the federal budget. Yields also ripple into the stock market. High bond yields offer risk-free returns, making stocks less appealing unless they promise even higher gains. This is the equity risk premium, and when it shrinks, investors may abandon stocks for safer bonds. The bond market's movements aren't just reactions, they shape the economy. As yields rise, borrowing slows, spending tightens, and economic growth can stumble. Bottom line? If you understand bonds, you don't just understand investments, you understand money itself.